protection.
Recording in progress.
Hi. Well,
Hi.
I'm Dave. Now that we're recording, what we're going to try to do in this next hour basically is show some tools that we can use that we have, available to us for the purpose of estate planning. I know that a lot of people use, our life insurance policies, and we have so many different types for just coverage. If we die too soon, right? If we live too long, if we get sick somewhere in the middle, and those are great puzzle pieces. But there's another great use for these life insurance policies besides businesses, and that is for estate planning. And we're going to talk a little bit about that. So I have a couple of case studies. Again, the camera, I got to be careful not to do too many gestures. There's going to a couple of case studies where we're going to show how powerful these products are in building generational wealth and protecting that generational wealth along the way. Okay. So that's my little intro, my prologue. Confidence with knowledge. I love that little, what do you call that? Byline. All right. So let's talk about me for just a few seconds. I am David O'Leary. I'm a PFD and a CFT, and I know a lot of you think that's a big BFD, but really what that means is I'm a company certified trainer with PFA. And I don't know if there's any guests on here tonight. I'm going to talk as if there are guests, but it should be just all for internal use only, everything that you see. So please don't copy anything or screen capture and put it out publicly. Let's leave everything for internal use only. Not that I'm going to say anything wrong. Everything I say is correct, but still. All right, you can reach me on social media. Just look for Dave O'Leary Agent or Dave O'Leary Agent 88, depends. I actually joined PFA from another company, and that was December of 23, about a year and a quarter ago. And we've had some tremendous success, and it's because of the power of these products. So a little bit more about my background, and I like to share my background briefly, just so that you can see something maybe that will resonate. I always believe that, whenever you're talking to people, especially new people, you should be completely authentic. Let them know who you are. Let them know. If you're trying to identify with somebody, we talked a little bit about this last night on how to do a one-on-one, and that is just find out who they are. Use the form method. Remember the form method? That's a family. Talk about their family. Talk about their occupation. What's the R? Talk about recreation. And M. What's the M? Talk about monkey. No, money, not monkeys. But just find out anything you can with them, because it's a way to connect, and they will probably they'll resonate with you, and they're going to be a lot more attracted to you if they have something in common. For example, being a veteran, if they're ex-military, we can talk that kind of language, because I also are one, right? Graduated from University of North Carolina, Chapel Hill. Anybody from North Carolina? They're going to know what that school is all about. I was in telecom. I was a real estate broker. I used to scuba dive and actually teach scuba diving. I'm a big, huge Elvis fan. So all these different things on here, when you see somebody else and you're looking for a trainer, know who your trainers are and all their kind of background, so that you can say, oh, I've got somebody you need to talk to because they also used to be ex-military, or whatever the case may be. All right, so enough of that. Yeah, I'm old. I could barely hold down a job, and that's why there's so many things on there. Okay, so let's talk about what I like to do is whenever I'm meeting with somebody, and let me go to here and maybe just kind of ding, stop sharing for a second. What I like to do when I'm meeting with somebody, whether it's a business partner and we're going over their own personal financial strategy, or it's a client, we're talking to a client with one of my business partners, or just one, just one of my own. I always like to find out, get a snapshot of where they are and where they're going, and be a little bit more holistic about our approach in how we can help them. I don't want to just go in there and if somebody asked me, how much is the life insurance? How much is $500,000 policy? And my answer is always going to be, well, I don't know. I don't know anything about you, well, unless I actually do. My point is, there's so much involved in terms of helping people financially that if all they ask you is for a quote and you give them a quote, you're probably not going to get that business, because they're going to hear an ad on TV, Big Lou, he's got one too, all these low quotes, and you're just going to lose to them. You have to get involved with them on the big picture, and look at it from the standpoint of how we can help them. Again, you have to be a doctor, like a financial doctor, and to get in there and try to figure out what's wrong. Where does it hurt? Get the hammer and hit them on the knee, all that type of thing. And what I'm going to show you is a spreadsheet. If anybody watched the case study I did, I think it was a few weeks ago, it's the same thing, but I got new clients now to show you. So I want to find out what's their family like, how old are the children. I want to find out what their plans are for the college education. I want to find out what their retirement plans are. I always ask what their retirement plans are. I'll ask them questions like, when you pass away peacefully at the age of 99 in your sleep, do you want to have a great, big, huge legacy of millions and millions of dollars that you're going to leave to your children? Or do you want to pass away peacefully in your sleep at 99 years old with $6.27 in your account because you were successful in spending everything, and they're on their own, right? They have to go figure it out. So everybody has to think about these types of things. And of course, my favorite answer is when they want both. They want to have a comfortable retirement, and they also want to leave a lot of money for their children, because now they got to start to ante up to do something like that. All right, so anyway, we want to find out everything about them and go through the questions, right? And if you need, when you're first getting started in this as a trainer, if you need to have a worksheet, or some type of client questionnaire, then use that. I've done it enough that I just like to bring up a blank spreadsheet and then just start asking the questions and filling it in. And the faster that you can get to something like that, I think it looks kind of cool that I can go through and fill out a blank spreadsheet and not have a tool that reminds me of these questions, right? But anyway, that's just me, a personal slant. All right, if anybody's got any questions, Brad, just shout it out. This is not formal. Anytime you've got anything that you wonder about, just ask, and I'll make up any answer I want. No,
Jason's online.
Jason's online, okay. Hi, Jason.
How are you? You want to sit there 5 minutes ago to Jason?
All righty, so let me go to the first spreadsheet. And again, these are case studies do I want to do this one? No, let's go do the other one first. I'm going to do, I need to share my screen, thank you. Bing, 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 start broadcast. And
so there is a message. It's song. I forgot to log off his Zoom account.
Oh, great.
You're safe.
No.
So weird to see that pop up from Jason's profile picture.
All right, can you all see this okay? You see this spreadsheet?
Yeah.
So this is what I like to do is when I first start with a spreadsheet, all I'm going to have in the spreadsheet basically are these colored blocks where it says, I've got a few columns dedicated to tax me now, tax me later, tax me not, right? And this particular client was not very forthcoming with a lot of information. He owns a roofing company in Florida, and he makes a lot of good money. They make like $400,000, but they've got other assets there that, he was kind of holding to, wouldn't tell me about, holding to the breast, right? And you probably come across clients like this all the time. They're not going to tell you everything, right? But you want to still educate them and use what they do tell you to go through and educate them on, the taxable buckets. So right now he's got a business that makes him all kinds of money. They've got savings, but the main thing that I was interested in was the fact that they've got oil and mineral rights. And right now they're being paid about $30,000 a year. Not I mean, it's free money. It's just, there's oil derricks out in Texas that are doing this, every minute, every hour, and they make money. And when his wife's mom passes away, those oil rights are going to go to them, and that'll kick it up to about $250,000 in income, right? So don't know when that's going to happen, but we know that there's going to be a succession of this. I'm not going to call it a business, but it is kind of a business. It's basically an entity that's generating income as long as there's oil coming out of that ground. And they have a value on that business. And typically when you evaluate a business, let's say you've got a retail shop and it makes $250,000 a year EBITDA, after tax, after everything. If they wanted to sell that, they might, depending on the industry, be able to multiply times 3 and sell it for $750, maybe $100 million for that business. When it comes to this, it's worth a whole lot more than a factor of 3 or 4 or 5 times the income that they're getting off an oil right. So they have a very high net worth, right? And these are the types of people that I love, because why? When you have a net worth, let's talk about net worth for a second. I'm gonna turn this off. I'm still boring people. They're logging in already. All right, so let's talk about net worth. When you come across a family that's got a very high net worth, and the way it works simplistically is that they have, and I'll just say that they have a net worth of $40 million, and that's all of their real estate, their businesses. If the businesses were evaluated and sold, the rights to oil, whatever they got, income, not just income, but stock, everything that they have that's an asset, all comes together, comes up to $40 million. These are high net worth people. What is the current exemption? So when somebody passes away and this estate goes to the next generation, goes to their kids, right? There's an exemption that the federal government gives them to basically exempt how much of their estate is not going to be taxed on that estate tax or death tax, depending on what you call it. And right now, the federal estate tax is at 40%. And depending on what state you live in, some states have an additional estate tax or death tax on top of the federal. So just talking about federal, all by itself, depending on where they live, that's 40%. So the exemption right now with the current administration is, the current is due to expire next year, but it's like almost $14 million. If you're married, it's $28 million. If you both have the exemption available to you. If the current administration had not gotten in office, it was probably going to sunset, and that 14 million would have gone back down to, I think it was like 6 million. So depending on the politics of who's in office, that estate tax exemption could be high or low. And if we're talking about trying to plan for somebody 30 years in the future, who knows what it's going to be at that point? All you can do is just get them thinking about it, so that if it does come back down to the lower amount at some point, and they've got a $40 million estate, well, even with a large one, even with a $14 million exemption, and if it's a married couple, that's $28 million of exemption, and that's still what, $12 million that's subject to the death tax. And at 40% of, whoops, I'm making the camera blink. So 40% of that 12 million, that's going to be a lot of money, right? That's like $5 million, something like that. 4.8 million. So about $5 million. We round it up. If the estate tax exemption is lowered through politics in the next 20, 30, 40 years, depending on when they both pass, because obviously if one spouse passes, the estate, assuming this is how they set up, will continue in the name of the surviving spouse. But when both of them are gone, now they may have to pay, their children will have to pay, in this example, $5 million to keep all of those assets. They don't have $5 million, then they have to start selling stuff to pay it off. If anybody's watched the shows on Paramount, I think, Yellowstone. That was a big one of the plot points. Is, oh my gosh, if we lose the farm, if we lose the ranch, we're gonna have to pay all the taxes. We're gonna have to sell everything. Anyway, this is something to consider.
Got
Question.
a question from Sandra. What if you put that in a living trust? Do you still pay the tax?
So if you have your assets in a living trust, it depends. The answer is always going to be it depends. First of all, what I want to do is say that I'm not a CPA. I'm not a tax attorney. So if I'm talking to you as a client, I'm not giving you tax advice. I need you to, we need to have a powwow. We need to have a meeting with your CPA or your tax attorney or whoever it is. However, this is typically how it works. Let's confirm that with your CPA. So to answer your question, Sandro, if you have it in a trust, let's say that you have it in a normal living trust, then that's still part of your estate because it's a revocable trust. That means you have the power to change anything you want to. You can change beneficiaries, you can change ownership, you can change anything if it's revocable. If you put it into a different type of trust, now suddenly it's going to change the dynamics, and that's part of what I'm going to talk about tonight. So thanks for that question, though. If it's in a trust, that doesn't change anything. It's still part of your estate, and you're still going to, your children will be hit up with that $5 million in this example. Okay. How are we going to protect that? Obviously, life insurance, right? By the time that they pass away, who knows what that's going to be? If they had an extra $5 million policy just to pay the estate tax, the kids can keep everything and they don't have to worry about how they're going to come up with all that extra cash to pay off Uncle Sam. That's the basics of what we want to do. Now, there's still some little nuances that we have to consider. For example, what if you just get a life insurance policy that you own, that I own, and I just have my beneficiaries paid, my children, then that extra $5 million policy is still part of my estate. And now the $40 million estate becomes a $45 million estate, and they're having to pay 40% on the $5 million life insurance benefit. Not because life insurance is taxable, but because it's the estate. It's the estate tax. Again, confirm all this with your CPA. But there is a way for us to get around that. Not really getting around it. It's a tool that people use all the time, especially high net worth people, and that is to take that policy, take the policy and put it into an irrevocable trust. Okay, let's talk about that. I'm going to do a whiteboard. And actually, I think I need to share whiteboard. There we go. Can you all see this okay? All right. An eyelet. No, not the thing above your eye. I'm talking about an irrevocable life insurance trust. Irrevocable. So the way this works is basically you establish a trust that is an irrevocable. This is specifically, there's lots of different irrevocable trusts out there, but this is specifically for life insurance, right? So you have the grantor, and he's also, by the way, the payor, right? He's the one that's going to pay. And he is going to create the eyelet, and he's going to fund the eyelet. But typically, typically that grantor is not going to be the trustee. Now, it's possible in some states that he could be the trustee or she could be the trustee, but it's not a good idea because you don't want Uncle Sam to come back and say, well, the grantor was also the trustee and they had all kinds of, access to it. They could change any way they want to. So we want to make sure, and again, this is getting outside of the scope of life insurance, but they're going to assign, whoops, I meant to say trustee. They're going to assign a trustee. There's other people writing on this. I had this problem last night. We've got a trustee that's going to manage the trust. And that could be a law office. It could be somebody that you really, really trust, but not the one that actually created the trust to begin with. Okay, it could be, it could be a family member. It could be Uncle Bob, right? It's important that the ILIT. Now what's happening? All right, it's important that the ILIT is funded in a proper way. And there is a 3-year rule. So if you don't, one of two things have to happen. You have to create the life insurance policy in the name of the ILIT from the very beginning, right? And some people think, oh, well, my gosh, I want to sell this policy now. And now we got to go find an attorney and get the trust set up and all this type of thing. Yes, you need to do that, right? This is your responsibility to take care of your clients like that. Let's say that they go ahead and get a policy, but they didn't put it into an ILIT right away. There is still there is still a 3-year rule. And what that means is, if you transfer that life insurance policy into an ILIT, and then there's death within the first 3 years, the government could do a look back and go back and actually treat this as part of the estate. If you transfer it to the ILIT and 10 years later, you pass away, then the ILIT is properly funded and is properly structured, and there should be no look back, and you should be safe. Okay, so typically it's that 3-year rule. Again, you can confirm that with your CPA. All right, so the trustee, what did I say? Oh, thank you. So the trustee is managing it. You see there's no connection there. And the beneficiaries could be the children, child. See, you don't even have to have good handwriting to do this business. You could also have have this set up so that the spouse is in there as well. So maybe it's going to go to the spouse first and then to the children. There's going to be a succession plan, but the bottom line is the grantor. If you're the one, the grantor cannot have access or control this anymore. It needs to be that trustee. Okay. So an ILIT, this is going to be a huge tool that we want to talk to them about when we get into estate planning, essentially. Understand how this works. Am I still sharing, or did I? Okay. Understand how this stuff works, but don't think that you have to tell them the details of how to set up an ILIT. They need to get an attorney for that, right? They need to go to a specialist for the ILIT, but you need to understand how this works, so that, because the more you understand, especially, for example, the exemption, the $14 million exemption, the more you understand these things, the more value that you're adding to your client. And even if they have other financial advisors out there advising them of this thing, and CPAs advising them of that thing, and attorneys giving them this advice, if you can come at it from a holistic approach, tying all these things together, you're more likely to stay involved with their case, right? How many people have lost deals because their trusted family member was married to a financial advisor and said, oh, poo-poo on this, right? If you haven't had that happen yet, you will. It will happen. But the more involved you are holistically, the more that you can explain and educate people on this, the more likely that even if they get this type of advice, they're still going to come back to you and say, well, what about this thing that he said or she said? And then you have an opportunity to come back and overcome that objection. All right. Okay, let's go back to the spreadsheet. Now that we've talked about that, bing, bing, bing. How are we doing on time? All right. So on this particular example, good morning. On this example, I'm calling him Landman, right? So he is the one that has the oil and mineral rights. He's the one that's got $400,000 income, just income, after they paid all the expenses from his roofing company, and they have the money coming in from the oil and minerals. All right. His wife also has good income. He didn't even want to talk about that. This guy was very, he did talk about his real estate. He's got a Florida home that's worth $1 million. And he only owes about 300,000. So he's got 700,000 of asset there. He's got an Oklahoma home. It's another 650,000. So I try to come up with some type of insurable need for people, not just say, oh, you need $1 million policy. I want to define it. And the way I define it is what? The dime method. So I love the dime method. Well, let's talk about it. How much debt do you have? They have no debt. How much income do you have? Well, he's making that $400,000, and we using the income and splitting it in half because his wife and him have an arrangement. Anyway, we figured 950,000 is the amount of insurance he would need for 10 years. Mortgage, $300,000 of the mortgage over here. And he's got one child that's 14 years old, another $250,000 to put him through some type of nice school. So he's got a total insurable need of about 1.5 million. By the way, he also has a term policy. I found out about the term policy before I went to the dime method because I didn't know why he got 1.5 million. What was the reason that you took out a 1.5 million 12 years ago? He's got 8 years left on it. I didn't want to just say, well, let's just replace your 1.5 million because he's paying like $250 a month. And now he's 61 years old. I think he's going to be paying a little more than $250 a month if all he wants to do is replace the term. And if you're coming at it from the standpoint of let's just replace the term, you're going to have problems because a 61-year-old's target premium, if that's all he's paying, is going to be way higher than $250 a month, right? For a 1.5 million. So you have to bring all these other factors in and show him how the life insurance policy is going to solve a lot of different problems, not just replacing a term, okay? Dime method, 1.5 million. I established that he actually needs that 1.5 million, right? Okay, so far so good. I would love to have more information on him, but here's what I did. I wanted to talk with him about the estate planning factor, basically the estate tax that his children will end up having to pay. And he's got 4 children, 3 adult and one that's still a 14-year-old. His wife is only 57. So let's go at it. We created some policies for him. And the first one I looked at was that $1.5 million policy. Well, again, if all we want to do is replace the term, we're going to have difficulty there. So I wanted him to start thinking about larger numbers in funding these life insurance policies. Not $3,000 a year that he's paying now, but something that's going to create generational wealth and or pay that estate tax. And if they don't have estate tax, great. They're leaving more generational wealth because that was part of what he wanted to do. I asked him about retirement. He says, I'm going to work till I die. So he's one of those people. I said, okay, fine. Let's just talk about estate tax. Trying to come up with a 50,000, and the reason I came up with 50,000 because I want to compare that to his wife also, who would get $1 million policy, and she's a lot more conservative, so she needs some more guarantees. And I'm going to compare his policy to her policy, which I'm suggesting as a whole life, not an index universal life, just so you see a little bit of difference here. All right. So in order to do a 1.5 million for a 61-year-old, $50,000 for 15 years. I'm having them funded for 15 years. It's not going to work. It's going to lapse. So I had to cut it up into, and we've learned about this before, a base IUL with a 750, with half of it being a CMC rider. That gives them the 1.5 million. And it gives them benefits, living benefits, even after, let's go to the tables, even after the 20 years is up, you can see that, let's see, 20 years out, it goes from 2.2 back down to 1.5. So it started off at the 1.5, and in 20 years, we've been able to grow this back up to 2.2, so that when the 750 falls off in 20 years, it's back to 1.5 again. Now, is his insurable need actually 1.5 at that point? Probably not compared to now, because his 14-year-old is already grown up and gone, right? The mortgages are paid off. All that stuff is paid off. At that point, now it's going to become more estate planning and or living benefits, because he doesn't want to become a burden, you know, on anybody. So the problem is, when you start looking at this, is he lives into his 90s, say 95. This policy has grown to $2 million, and that may or may not be enough for, you know, the tax problem that we were speaking of earlier. But still, he does have, let's go back to the beginning, he does have some living benefits, and that's something else that we can sell with these policies better than anybody else out there. If I become ill, you can see right there, $747,000 lump sum for critical injury, critical illness, et cetera, et cetera. $13,000, almost $14,000 a month for chronic illness, and that's at the age of 66. All right. Let me look at a $1 million policy, because perhaps we can mix and match some of these things. I looked at a $1 million policy on him, and I didn't need to do a CMC rider. It's just a straight $1 million policy with that same $50,000. And now you can see that the benefits actually start getting better. So the living benefits, instead of the 700s, are now in the 900s. You know, instead of 13 million, it's now 17 million for chronic illness. So all the benefits are looking better for him, and that's going to be an advantage. But we have down here, when we look at the tables, $1 million by the time he's 95, it's still around $2 million, right? So it's giving him greater living benefits, and it's funding this thing better so that it's less likely to have problems, because if we're putting the same money in, but we lower the death benefit, the cost of insurance is lower, less likely to have problems, because they're concerned about the guarantees of these things, okay? So I'm suggesting this for him. And if I go to his wife, land wifey, here we go. Look at the difference here. This is a whole life product, total secure. What's whole life mean? It's not an index universal life. It's typically a little more expensive, but it's guaranteed, right? You have the guarantees with a whole life product. Let me show you what I mean. Oh, here we are, same summary page. She's got living benefits, same living benefits. That's the beautiful thing about National Life Group. All of these different policies have these living benefits, including critical, chronic, even the Alzheimer's. Lump sums in the 700s when she's 65, very similar to the 1.5 that he had, but she's only 57, so there is an age difference, and she's a girl, right? So their cost of insurance is not as high as ours at the same age. But if we look at the tables, you always think about whole life having to pay on it for your whole life, but that's not necessarily true. It depends on how you design it. If you design it so that the dividends that they get at the end of each year goes back into the premium, you can actually stop. You'll not have to pay it for your whole life. In this example, she ends up not having to pay on this whole life product any more than 13 years. So no more premiums after 13 years. And that's kind of nice, right? And you can see also there's a guaranteed table and the current illustrated value. And when you look at both of them all the way to age 99, this is the big advantage of the whole life, is that she's got a guaranteed benefit of $1 million. Doesn't matter. Guaranteed. Remember, on the IUL, there's always a lapse on the guaranteed, you know, not always, but it just depends on how you fund it, right? On the non-guaranteed side, it goes all the way up to 1.3 in this case. Well, at 95, it goes up to 1.2 or so. So you don't get the same type of growth potential, but you do have the guarantee. And that's something that some people are going to need. But wait, there's one more product that we can talk to them about, especially when it comes to estate planning. And I want to talk about the survivorship policy that we have, because there's a couple of advantages of a survivorship policy. First of all, let me go back and look at the 1.5 of, oh, I might have to actually go to the illustration. I can tell you that on his 1.5, the target premium was like around $46,000, if I remember right. I'll bring up the illustration to show you. The target premium for the survivorship product with both of them is always lower. The cost is always less, way less, when you do a survivorship policy. And for those that aren't familiar with the survivorship policy, basically it is a policy where you can insure two people, in this case, the man and the wife, landman and land wifey. And what happens is typically it will pay, the death benefits paid out when the second person passes away, which is what they want this policy for if it's for estate planning, to pay off the $5 million in taxes to the children, so that they don't be straddled by Uncle Sam and have to start selling off parts of that estate, okay? So on this one, the way we designed it was, it's a different illustration. Let me go to the tables. Bing, 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 bing. This is it starts off at basically a $2 million policy. And they're going to fund it with, actually, I'm sorry, 1.8. 1.834 is the initial death benefit on this. And they're going to fund this with $150,000 a year for 5 years in a row, and then they're going to quit. There are people out there that will fund their life insurance policies this aggressively. You have to believe it, and you just have to understand and know and have the confidence that these tools are so powerful for them. And then you will start to manifest these types of clients. How much time do you put into a term policy, right, for somebody that makes $30,000 a year versus designing something like this? This takes a few minutes longer, but you're going to spend the same hour explaining things, right? Maybe an extra hour, but you're going to really affect people's lives so much more dramatically with these products. And of course, it's going to affect your own business quite dramatically too. So $150,000 a year for 5 years in a row. And you can see that by the time she's 95, what happened? Current. There we go. By the time she's 95, what do we have here? This thing has grown to over $5 million. All right. Now, this is a powerful product, but I want to show you how we illustrated it. Oh, and there's some other tools that we can use with that survivor that you don't see in other ones. So let me just go into the actual ding ding ding. Everybody okay so far? Questions? All right, go to the illustrations. And let's look at Landman Survivor. Okay, so when you do a survivorship policy, it's going to ask you for both clients, right? Duh, it's covering two people. Let's talk about living benefits on a survivorship policy. Are living benefits included on both of them when you have a survivorship policy? No, it's not included. However, when the first person passes, the second person can apply for the living benefits. At that point, they can do that. They'll have to go through a medical underwriting, but they can do it. The biggest purpose of this is not for living benefits, it's for estate planning. Exactly what we're doing right here. Death benefit and funding. Let me show you a difference between just putting let's say $2.5 million, because a lot of people would start off with a large policy, a large initial death benefit, right? So that they can get to, let's say 35 years down the road, they can get to that. That's only 3.7. Let's go. How many years do we go? Let's see, she's 57. By the time she's 95, that's 39 years down the road. Let's look at 40. We'll just look at 40 years down the road. I love this little tool down the bottom corner, because I can monkey with the settings and down there, just see how it affects us immediately, right? So with this design of 2.5 million, putting that $150,000 in for 5 years, in 40 years, when she's 97, there will be a death benefit of 4.5 million. Well, is that really the best way to design this? If you know what their budget is, if you know they're going to put $150,000 a year into this, then look at the guideline level. The guideline level is 187. It's like wasting some of the policy. We're not fully funding it. We're not max funding this policy. It's not as efficient as it could be. So what I want to do is give these people the policy that's the efficient for 150. And even if it's an IUL that you're doing for the same reason, and they have a $5,000 a month, budget, or $2,000 a month budget, you can do this exact same thing, which is design a policy that is going to maximize the efficiency of the budget that they have. And the only thing that you have to take into consideration is what if they change their mind later and want to put more in? Maybe you want to give them a little bit of room. In this case, they do have room. But if I just want to make this completely efficient, I'm going to, instead of 2.5 million, I'm going to say, give me the minimum death benefit with that maximum cash value. And now you can see that this is creating a policy where the maximum non-MEC is 152,000. And that's where that policy, that's where that initial death benefit came from of 1.8 instead of 2.5. But now look, in 40 years, it's not 4.7 million, it's up to 6.2 million. That's a pretty significant difference. So make sure if you're designing a policy for maximum cash later, especially when it comes to estate planning, that you don't just assign an arbitrary number for the death benefit up front. Make sure that you're designing it as efficiently as possible. And in this case example, I know what the budget is, 150,000 a year for 5 years. And then I'm going after the lowest death benefit just by, it's such a great tool. All we have to do is just point and click. It tells us what we need to do. All right. But wait, there's more. On the survivorship policies, there's some extra riders there that you don't see on our IUL. These are cool. Okay, remember the 3-year rule on the ILIT that we talked about a few minutes ago? I'm bringing it all full circle. Yeah, that 3-year rule. So for example, if they take this policy out in their own names, and they both get into a horrible car accident in 2 years, Uncle Sam's going to come back and say, look, you bought this policy in your name and then you transferred it into an ILIT 3 months later, but it's less than 3 years. We're going to count this 5 million, well, whatever the millions are at that point, we're going to count that as part of your estate. So National Life Group gives us an extra rider that we can avoid that problem. And this only works for married couples. If the survivorship is like a mother and a son, which you could do, or some other relationship that has an insurable need with each other, you can't do an 80-year-old and his great-great-grandson, right? That's too big of a difference. There are rules. But if it's a man and wife, then there's a couple of extra goodies that we can throw on here. For example, estate preservation. What's estate preservation? Only available when the man and wife. Estate preservation basically is they buy this in their personal name. They have 1 year. National Life Group gives them 1 year to move this into an ILIT. And if they both pass away within those 3 years, National Life Group will pay the extra tax. That's hot. Right now, you don't have to wait for that attorney to do an ILIT and then we'll sell the policy and move it into, no, you could do it now and it gives them a year. You just activate that little rider and it gives them a year to move that into the ILIT. Now, does it change the target? Let's look at the target. If I say no, it's the target is 29,998. Okay. There's a little bit of a cost, right? And if you want to see what the cost is, you just run an illustration and go look at the extra cost. It wasn't much of a cost because it changed our from 3,010 or 30,000 down to, let's say yes, it's going to ask you what the tax rate is, down to 29.98. What's that difference? $12. It's not much of a cost. What happens if their state tax rate is 40%? Okay, an extra $3. So you want to make sure that you set that tax rate to whatever you anticipate. There's a scary one. What you anticipate the estate tax to be. Well, if it's in the next 3 years, you probably know what it is. It's right now it's 40%. That's hot because now you can sell the policy and then give them 1 year to move it into an ILIT. Set yourself some reminders to follow up with these people in 3 months and 6 months and make sure they've done it. Oh, I forgot. You're right. I got to get that done. Right. If one of them passes away, remember we talked about the estate tax exemption. It's like almost around 14 million right now. And if it's a married couple, it's 28 million. What if the first one passes away? The first one passes away, and I've dealt with a client in Dallas, and her husband passed away 3 years prior. She's ultra high net worth type of client. The IRS gives her, right now it's 5 years. 5 years to file a form with the CPA and take the unused exemption from her past husband. Her husband passed away 3 years ago. If she doesn't file that form, her estate tax exemption remains at 14,000 or 14 million. If she files the form, she can now include in her estate the unused part of her husband's unused estate tax exemption. Does that make sense? In other words, it still stays at 28 million, but she's got to file that form. So if you have a client where spouse passes away, or you find out that the spouse passed away a few years ago and they have estate tax issues because they're high net worth, even if they're not, throw it out there because, you know, it's giving you more value because who knows? They may know people that have this issue and will refer them to you. All right, so that's one, estate preservation. A second one, and this is ominous, is policy split option. And that's also only available if it's a husband and wife. Well, this is California. Only if it's spouses. I probably shouldn't. Anyway, if they're married, spouses, these two options, these two riders are available. And what that means is they get divorced, they can go their separate ways with their separate policies. In other words, take that survivor policy and split it into two, and everybody gets their own. All right. Does that change the cost? Let's look at that. Probably does. So right now we're at $29,995. Let's take that away. Yep, didn't even change the cost. All right. I love it. I love this little, if you don't use this summary box down here, you need to really get used to it because you can come up here and monkey with things, change things around and see how it affects it immediately without going all the way to the, you know, quick view tables and scrolling up. Okay, was this useful? Do I expect you, how are we on time? Do I expect you at this point to suddenly become estate planning gurus? No, of course not. But I do want you to realize the power of what we've got and the power of what we can do for our clients and how we can be, like I said earlier, more holistic in our approach. Don't ever just go in and say, well, here's what it's going to cost to replace your term. There's so many more things that we can do with that policy besides replace a term, adding living benefits, giving them a tax-free income stream for their retirement, estate planning that we just talked about. You know, all these different ways. There's 87 different ways, I say, to design an IUL. And now you've seen even a whole life policy where you have the guarantees the whole way through. You know, so if somebody's really, really conservative and they're thinking about the guarantees, it's not going to give them the cash upside, you know, potential, but it gives them the guarantee. And it gives them all the same living benefits, which is beautiful. Now you may wonder, I'll throw this in here. Let me go back to the illustrations. I guess I'll share my screen one more time. Ding, ding, ding. There's two things I want to look at because you're wondering, well, why should I, So if I go to, let's go back to cases, because this is the survivor. Oh, and look at that. Let's see here. Now let's go home. And let's look at landman. There we go. So again, with the $1 million, $1 million, let's go to 1.8. 1800000. I just want to show you the difference in a $1.8 million. What happened to my, oh, there we go. Target premium on our 61-year-old is $74,000 for 1.8 million. $74,000. Survivorship, that 1.8 million is around 30,000. That's the fees, right? That's the cost of insurance. That's reflected in the cost of insurance. It's like less than half of the old man. And that's phenomenal. If they're looking at this for estate planning, don't forget about your survivorship, because they're going to be able to get more for their money, a lot more for their money. The second thing I want to look at or bring you on to, because target premium means commission too, right? That's how we get paid on those annual amounts. When we look at whole life, there's something you may not realize, and that is that there's no target premium on a whole life policy. There's a contract premium, and we're getting paid on what? We're getting paid on the contract premium. So I'm throwing that out there because you may wonder, how do we get paid? What's the difference? Yada, yada, yada. Yes, we want to help people. And the very first thing we want to help people. That's the very first thing is doing what's in their best interest and what's suitable for them. But this is also your business, and you need to run your business. So you need to be able to track where you are towards your trip. Okay. And that's how you track it. You'd be getting almost 26,000 points on the land wifey. All right. Do we have time for one more spreadsheet? I won't go into all the illustrations or anything, but if I could spend 3 minutes giving you another example of another client that I'm working with right now. And that would be, we'll call them Denny and Jan. Okay, these guys are a lot more forthcoming. They gave me a lot of information. So I'm just going to quickly give you the highlights of what I've collected from them and what we're proposing. Denny makes 210,000. Jan makes 130,000. He's got an eBay business where he makes an extra $10,000 a year. It's cute. $333,000 a year. They're making 3 diamonds, right? And they do normal jobs. Okay, so they're making pretty good money. Oh, this is the sickening part. He's 39 and she's 33. Right? I say sickening, I'm being sarcastic, because I wish I had my act together that much when I was in my 30s. All right, so look at this. They've got a couple of properties. They have one here and one in Ohio. Here's all the numbers on that. They both got old 401ks. Look at the orphan 401ks on these people. Oh my gosh. Make sure that you're thinking about the retirement planning, because these guys have, okay, so she has 3 orphan she has 3 orphan 401ks, 11,000, 65,000, and 28,000. And the husband has 2 orphan 401ks from previous companies, 505,000 in one of them and 60,000 in the other. They have $671,000 of orphan 401k money out there that is subject. Number one, all that money is, on Mr. Toad's wild ride when it comes to market volatility. They could be losing, and they have lost money because obviously the market's been ugly in the past few years at some times. So we can help them with part of this part of the strategy, moving it into a more conservative traditional IRA where the underpinning is our fixed index annuity. Same technology as our IUL. Zero is the hero. I love this. They just recently changed jobs, both of them, because their current IRAs are like at 7,000 and almost 3,000. So they're funding what they currently have, but they have $671,000 out there that's available to be rolled over if it's appropriate, right? If it's appropriate. What makes it appropriate? Whenever you go through a life insurance policy with somebody, they're doing a medical underwriting, right? They want to look at their health. Whenever you're doing a rollover or an annuity, they don't care about the health. They're looking at the financial suitability. And typically if you're just doing if you're setting up a Roth, we set up, I've got some, I've got some clients, not my clients, I'm CFTing some wonderful people out of Ohio. And they have put in motion 4 annuities this week. 2 of them are just traditional IRAs with $7,000 funding, and 2 of them are SEP IRAs where they're putting $50,000 into a SEP IRA, all in just a couple of days. There's not a lot of suitability need for that, because as long as the CPA says, yeah, go for it, you can stick 50,000 into a SEP, that's all right. Every time they come back at me, the other agents that are still working on their own CFT, they say, well, how much can we put into this IRA? Here's how much they make. Here's how much that I'm like, we got to get the CPA involved. If they want to put 50,000 in, great. Make sure the CPA is good with that number, because that's where they're going to get in trouble. Then they're going to come back and blame us. Make sure you get it in writing from the CPA that 50,000 is good. And the CPA says yes, and then we can set up a SEP in an hour. $50,000. Not a lot of suitability. It's not difficult to do that. The part that they look at more closely is when we're going to start moving lots of money, rolling over $671,000, for example. And what they're going to do is they're going to look at their total net worth. And the rule of thumb is that our National Life Group or any carrier doesn't want to see the rollover to be more than 50% of their liquid net worth, right? Because they consider the annuity to be non-liquid because of the surrender fee. Well, everything has a surrender fee. If you take money out of the IRS, out of a 401k right now, I don't consider that liquid, because they have to pay taxes and they have to pay a 10% penalty, because they're not even close to 59.5. Anyway, you got to play the rules. Make sure that you're talking with a CFT that understands these things, and keep you out of hot water, keep the client out of hot water. But in this case, they pretty much told me that they want to protect all $670,000 of that. And that's going to grow into what? It's going to go into a growth annuity. Why is it going to go into a growth annuity? Because they're in their 30s. They still have decades before they retire. Okay. Well, here's what we said. Oh, and then I asked them, when you pass away peacefully in your sleep, what do you want? And they said, well, we want to leave a big fat estate, lots to our children, but we also want to have a very comfortable retirement. Okay, I won't go into a lot of details, but here's what I'm setting up with these guys. Again, dime method. You can see that the husband has a $3.2 million need, according to the dime method, and the wife has a 3.2 and 2.3. I'm not dyslexic. That's how the numbers came out. All right. I'm actually coming up with their insurable need based on what kind of school they want to send their kids to, and what kind of mortgages they have, et cetera, and of course their income. Right. These guys are like on top of it. Look what they've already done. Winnie, their 3-year-old, they have $15,000 in a college fund already, a 529. And Florence, who's 9 months, they've already got almost $3,000 in that one. So these guys are all about putting money into their children because they can. So right now, what I'm suggesting is that they get the insurance that they need based on their insurable need. $3 million for him, $2 million for her. And why am I rounding it down like that? Because when they do the rollovers, there's a death benefit there as well. Our annuities also have a death benefit that's associated pretty much with the cash value, right? So that's filling the gap right there. Winnie and Florence, we're giving them $1 million. Why am I giving them $1 million policy? Because I'm going to use the children for part of their retirement strategy, part of the parents' retirement strategy. This is what we're going to set up now. And in 20 years, the growth from Denny's IRAs are going to have gone up to 1.5, almost 1.6 million. The wife is up to 827. And I know this because I set up a Zenith growth annuity, put their money into it, and then went fast forward 20 years and saw what the values look like. And then my next step is to roll that, transfer that money into an income annuity and get them set up for lifetime, guaranteed lifetime income. However, I want that money to grow in that GLIR for a little bit longer, because first of all, in 20 years, the wife is only 33, so she'll only be 53. She can't take any money out of her, out of her fund, out of her qualified fund. So we're going to start taking money out of the child's policies. 2 children policies, we have funded it with, what was the funding? It was $2,500 a month in each one. That gives them $300,000 tax-free income in 20 years. And we're going to do that for 4 or 5 years. Why? Because then I'm going to drop them down to $200,000 income from those IULs. Why? They're college. They're paying for the kids' college. So that's an extra $50,000 a year for the kids' college. All right. And then we continue that path. We continue to let the annuities bake. And at that point, in 25 years, we've got 3.1 million and 1.2 million in their annuities. You can see that the death benefits have grown because that's a combination of the life insurance, the IULs that they have, added to the death benefit that they would be receiving from the annuities they've been baking all these years. And then 30 years, we turn off, well, actually, yeah. So 30 years down the road, we've turned off the IUL income, and now we're going to the guaranteed lifetime income, adding up to $500,000, $503,000. All right. In estate planning, they wanted to have a comfortable retirement, and $500,000 sounds like a lot of money right now to retire on, but we're talking about in 30 years. So that might be worth actually $200,000 in today's numbers. There's calculators, you can figure that out. Their estate continues to grow. In 50 years, when they're in their 90s, their estate has continued to grow. What I didn't show here is how much Winnie and Florence's IULs have actually grown to. So on their policies, the little children, 9 months old, they were able to use the children's policy to fund their own start their own retirement in the early 50s, also fund the kids' college, then stop taking money out of the children's policies. Don't put any more money into the children's policies. Let them grow until the children are 65, I think is what I demonstrated, from 55 to 95, from 55 to 95, 40 years, the children will both each be able to take out $300,000 a year for 40 years, tax-free, out of those same policies. And those policies have grown to where the grandchildren are going to receive, it sounds like crazy numbers, but if they lived it until their 90s, the death benefit has grown to like $50 million. And they only funded it for 20 years. The current parents have only funded it for 20 years. And they have just changed the lives of their children and their grandchildren, generational wealth. All right. Obviously, at some point, those will have to put into an ILIT. So That help? We talked about estate planning concepts, irrevocable living trust. We talked about exemptions, and the government right now gives 14 million per parent or per person. If you're married, that's 28 million. Who knows what those exemptions will be in 20, 30, 40 years? So you have to plan for that. You have to plan for worst case scenarios, and make sure that your clients understand how powerful these life insurance policies are. And if it seems too pricey, be looking also at the survivorship, because those are less expensive policies for estate planning. And they have those extra goodies on there. So, all right, any questions or anything come up from all that? I don't expect you to understand everything we just talked about, except the high level part, which is, oh my God. You have that, you make this kind of money, or you have this kind of estate, or you have this many pieces of real estate. Have you thought about what your children are going to have to pay in estate tax? Have you thought about how we can help you with that? So if you're still out there trying to build a business and figuring this stuff out, just turn on the radar to all the things that we can do for a client, and then point, right? Find the clients conversationally, talking to people, and then point. Oh my gosh, you need to talk to my partner. You need to talk to, I've just started my own business, whatever, however you approach them. But get them to a meeting. And don't be in a rush, because the higher the stakes, the longer it's going to take. But you just got to follow up. All right.
Got a question. How much premium does the young parents need to put into their insurance policy on your last example?
On that last example, they were putting $2,500 a month. $2,500 a month for that. Now that is so that they could take out, what was it, $300,000. Well, on each one, $150,000 after 20 years. So $2,500 a month, $30,000 a year for 20 years, and then no more funding. And they can take out $150,000 a year for 4 years, and then $100,000 a year for the next 6 years. That got them into their qualified funds, where they can start taking money out of their annuities. Let the children's policies continue to bake. It just sits there and grows, right? And they've got all the living benefits that are attached to that. And by the time the kids are 55, they can start pulling $300,000 tax-free, and still until they're 95, and still leave tens and tens of millions of dollars behind to their grandchildren, to the parents' grandchildren. Yeah, to answer your question, it was $2,500 a month.
They can start taking it at 55 or 65.
Whenever they want to, but in the example that I gave to them, I showed them 40 years worth of distributions from 55 to 95.
Right.
Because who knows what the actual retirement age will be at that point. Right now it's 59 and a half. It didn't always used to be 59 and a half. It keeps sliding up. So it doesn't matter what the retirement age. It's a life insurance policy.
Right.
I designed it so that they can start pulling out at 55. If they want to pull out at 45, they can do that. It just won't be as much money. They also have a lifetime income benefit rider they can turn on. At what age?
65.
60.
Oh, 60.
But you're right, it's older. So if they want to do the lifetime income benefit rider, that's at 60. And the lifetime income benefit rider it's two things different about what my approach. One is lifetime income benefit rider is starting at 60 and it goes to M, right, to 120.
Right.
And it's using the standard loan. It won't do the participating loans. So it shows the good part is when you turn on that rider, it never lapses. It doesn't matter what the cash value does, the policy will never lapse. And that's a beautiful thing. That's a guarantee.
And it's at 60 for the insured. So what,
Right.
whatever the age of the parents are, it's 60 for the insured.
Well, if the parents are still around when they turn 60, I want to know what they're drinking. But no, it's for this, the insured turns 60. That's a good point. And what I do is I'll demonstrate from like 55 or 65 until 95. Because most people don't think they're going to live much longer than that anyway. Nobody thinks they're going to live to 120. And if you want to show them the power of this thing, then you're gonna use a participating declared loan instead of the standard, because the revenue is just a lot bigger on that. And you don't have to go to 120, you just show it to them. Does it matter? Do they have to decide right now what type of loan and when they're gonna take it and all these things? No. All they have to decide right now is what's the death benefit gonna be? Any extra riders they wanna throw on there? And how much they're gonna fund it with. And even that can change. When they start taking money out, they can decide that later. You can decide it together with them because you're doing your annual reviews and you're monitoring their policies and the cash value and the allocations and seeing if everything's working for them, right? Great question. Anything else? Okay.
Thank you.
Well, we ran a little bit over. I'm sorry about that. Sue me. Oh, picture time. Are you getting pictures of the
Yeah,
3 people that
before-
are online? Right, there's 12.
Yes, before people.
We've lost a few
were
people.
Jumping off, I.
All right.
Pictures.
Great. All right, super. Well, then let's get a picture of the people that are in the room. And everybody can get tight. Everybody just come.
I think, other reason that, I need to rush real quick.
Oh, okay.
So we're
We'll go
holding up
slow.
the picture on you.
All right. Well, thank y'all. No other questions? We'll go ahead and shut down the Zoom.